Hi, welcome to CFO On Demand. Today I want to talk to you about the 5 top key performance indicators, or KPI, that every business owner must know in order to grow their business. Number 1, current ratio. It's also known as the working capital ratio. It's your current assets over your current liabilities. Current assets are cash, accounts receivable, inventory. Current liabilities are accounts payable, short-term debt, and the current portion on short-term loans and notes. The current asset ratio is very important because it tells business owners, as well as the outside public, how well your business is able to pay its current expenses. It also tells them that your company is able to weather certain difficulties, either internally, such as changes in personnel, or externally with competition. The second indicator, EBITDA, earnings before interest, taxes, depreciation, and amortization. This indicator is important because it tells business owners how profitable the company is outside of any capital improvements or any debt service. It is also an indicator that's commonly used when people try to develop rules of thumb or shortcuts in valuing a business. EBITDA, real important indicator. Third, debt service coverage ratio. That's a mouthful. Banks love this one. It helps them determine how much a particular business can afford in debt. It's determined by taking your EBITDA less any distributions you made to the owners, either through capital accounts or any kind of distributions, divided by the current principal and interest on your debt. It's called debt service coverage ratio. If you borrowed any monies from banks, that's usually a ratio they look at. That one, they like it to be at least 1.2 or higher, 1.2 to 1. Fourth, operating efficiency ratio. This takes your total expenses for your company, that's cost of goods sold as well as operating expenses, divided by sales. So that number might be something like 70% typically. Why this indicator is very helpful is it tells business owners how efficiently management is in controlling costs, mostly variable costs. Fixed costs are hard to control. So variable costs such as labor, advertising, depending on the type of business you are, can be very high. This way you can see how much you're able to keep of that dollar that you bring in as revenue. Big indicator here. And lastly, free cash flow to equity. This indicator is the cash flow of a company after operations, after it's paid its debt service, and after any capital improvements. That's the cash flow of the company that's available to the stakeholders. This indicator is very common when people are interested in buying companies. They want to see how much cash flow is available after all those costs to see what the owners can bring back and how long it's going to take to have a return on your investment that's acceptable. So that's called free cash flow to equity. Hopefully these 5 indicators are ones that you know, and I strongly consider you looking into them if you haven't already and monitoring them at least on an annual basis. Thanks. Talk to you soon.